Welcome to the Sustainability Action Society podcast. Today I welcome Dr. Kaiser Naseem, and we're going to have a conversation around finance, blended finance, and related topics. Dr. Naseem, would you be so kind and introduce yourself?
Well, I can do a quick introduction. So I am an international development banker, having worked with the World Bank Group for many years, actually more than 50% of my career. But of course, I've also worked in industry. I've also worked in a commercial bank. But I would call myself a development banker. And the difference is that obviously we work in developing countries. We try and improve the livelihoods of individuals, add value to the economy of developing countries. And there are various ways, we'll probably be talking about some of them, that we do that. So currently, I also sit on boards of several companies globally, and these range from commercial banks. So there's a huge commercial bank in Uzbekistan. Then there's a startup, no longer a startup, but a tech company called Engine Starter. It's a metaverse company. So I'm on the board of that. I sit on the board of institutes of corporate governance in 2 countries, and also on the board of a microfinance institution. And I'm also on the advisory board of an ESG advocacy firm out of San Francisco. It's called Advanced ESG. So I'll just stop here.
That's quite impressive. I wouldn't have been able to introduce you this way. So, given your background, you know how nowadays there's so much conversation when it comes to sustainability and leading up to COP28 here around blended finance. It's a topic that I've heard now several times that has come up. Can you explain for the listeners what is blended finance?
Right. So look, firstly, the reason we have blended finance now is because money is scarce. There are a lot of projects, and especially when you're looking at sustainability and now climate. So we have, a suite of projects emerging from different countries on how to tackle the climate issue. And for that, obviously, you need funding. A lot of these, projects need funding, and not just climate, any project in developing countries. And you have various instruments and various modes of financing them. The issue is, how do you structure that financing so that it's smart, number one, and it actually works towards the development of that project. I'll explain that in more detail. So blended finance is just blending a few types of financing. Now, I'll give you examples. There's long-term finance, there's short-term finance, there's project finance, there's grants, there's what's it called, discounted finance or cheaper finance. So all these are different types of financing that are available. Now, you cannot use just one type of financing for a project, so you got to blend them. And there's a reason for blending them is so that the project that you are targeting with the funding becomes viable. Again, I explain what that means. In developing countries, but before that, let me just backtrack. And you also need to blend financing because, like I said, financing is scarce. So a lot of development financing comes from, ODAs, from, bilateral development institutions and multilateral like the World Bank Group and the Asian Development Bank. But there is now need to also involve the private sector and to bring them in. So one part of the blended finance is the private sector financing that comes in. That's not the easy part. And the reason for that is that private sector is very reluctant to go into a project in a country which is probably doesn't have the right regulatory framework, or the market has not been created yet. Let's say power, for example. So the tariff, if it's too high for a particular country, no private sector would want to go in and invest in that. So that's why, in order to attract private investors, you need to make sure that you have a blend of financing instruments within that funding of a particular project, which makes it palatable for a private sector to come in also, which means that they can look at a return which they would accept. And then we can get into the instruments if you have a question on that.
Yeah,
but this is basically what blended finance is.
So, but it's not only related to the return, it's also to the risk mitigation, right?
Absolutely. So that's, the private sector is scared of the risk. That's what it is. You go into a country It has no regulatory framework, and you go in and set up a power plant. You don't have any regulatory framework for regulating the tariff, for ensuring how the funding is going to be, dispersed. So they're reluctant to do that. So this is where other modes of financing, like donor funding, which might be cheaper, or even grants can come in. And the way they would work is they would probably at 2 or 3 levels. One is the advisory level, and one is the financing level. Now, in order to make a particular project more, palatable for any investor, but let's say private investor, you need to make sure the regulatory framework is there. So the cheaper mode of financing or the grant funding can go to develop such regulatory frameworks in countries which don't have them. And this is what is being done in many countries. Once you have a regulatory framework, you can also have funding which is at lower rates, which is also provided by bilaterals and multilaterals, which can then reduce the tariff, for example, of a power producer, which then creates a market for that power because the people can then afford it. So in such a structure, private capital would come in because there is an offtake because of the cheaper tariff. And the cheaper tariff is there because of the concessional financing that was available from multilaterals and bilaterals. So that's how you de-risk it. The other ways of de-risking is, there are many more. So there are guarantee facilities, for example. The first loss guarantee is available. These guarantee facilities are again set up with concessional financing by multilaterals, bilaterals. So if a private sector invests, let's say, in a small or a medium enterprise in a developing country, they would like some sort of protection. So the first loss could be protected by a credit guarantee. It could be protected by an insurance product, for example, crop insurance, and so on and so forth. I mean, there are separate instruments that can be created. The thing is blending all these smartly. Now, the reason I say that is because for using this type of financing, you need to be very cautious. And the reason you need to be cautious is because, firstly, again, I keep saying that funding is drying up for various reasons. One of them is political reasons. So countries like, let's say, the DFID of the UK or even the USAID of the US people are starting questioning that we need money in our own country. We have energy problems in London, right now tariffs are going up.
Yeah.
So why are you subsidizing tariffs in other countries? We don't want to give aid anymore. So these are sort of the debates going on in these developed countries. So it's scarce. Therefore, that scarce resource should be used responsibly. And, responsibly means that if, sometimes they don't need to provide a concessional mode, but institutions might do it to become more competitive. And they've done it. Multilaterals have done it, actually. They've used concessional finance to be competitive. We can get to that problem also. There are a lot of issues with multilaterals.
Yeah.
Exactly. But these are the type of issues that you need to be very sure that there is a development impact, especially when you're involving a DFI. You need to be very sure that there's an additionality. Why have you involved a DFI? Is there any additionality that the DFI can bring in? And the third is, what is the rationale for concessional financing? So these 3 things have to jive, and that's the difficult part. I mean, it's not being done properly right now.
But from what I understand is it's really kind of like an ecosystem. It's not just the multilateral development banks and private sector finance. It's also getting the right regulatory framework in place, working with the country to develop that together. So it's really more than just financing, right?
Absolutely.
And my question is, if all these structures already exist, why is there still so little going into developing countries? And what is the reservation? Do we need new structures? Is it time to rethink the way that it was done previously? Also to encourage maybe more private finance to go into this. What is your perspective on this?
Well, this restructuring is long overdue, actually. I think the inherent problem is, let's start with the development finance institutions. Actually, they were the ones who led, the way to get involved. Like I mentioned, I've been a development banker to develop underdeveloped countries. So that was their role, bilateral and multilateral both. And initially, private sector was not pulled in. It was just these multilaterals which did it, and they were funded by member countries. I think the issue was the way they did it, and that's why I keep using the word smart. Maybe it was smart for a certain number of years when the issues facing the world were not that wide. Well, initially it was just Europe, right? IBRD and the World Bank was just focused on Europe, but later on they expanded into more into developed countries because they had the people, they had the knowledge base, perhaps. But the funding part, the impact was not captured in the manner that it should have been captured, and then you can tell a story where other investors would then come in. So even today, the evaluation of projects is not done in a manner that can convince others that there has been a real impact. And it's not, I'm saying that, but it's not an easy thing to measure in any case.
Yeah.
But one would think that having been in existence for 70 plus years, the World Bank would be able to do that now. But even now, it's not a perfect science, let's say, or they're not doing it in a perfect manner. And hence, bringing in private investors and convincing them that, look, this is what we did in the developing countries and this has been an impact. And if you come in with us, you can also be part of that, is not a convincing statement at this point in time. And again, then we get into various reasons, the multilaterals. By the way, right now, this is being discussed. The spring meetings of the World Bank and IMF are taking place as we speak. And I think one of the major agenda items is, they don't call it restructuring, they say evolution of the World Bank. They're discussing that.
Which sounds great.
Yeah, it sounds great, but evolution is evolution, right? You don't make evolution. Evolution happens. So it didn't happen. The World Bank should have happened because, the World Bank is supposed to be a knowledge base, right? People who are thought leaders and they know what is going to happen in the next decade. But that obviously didn't happen. The World Bank also has been caught unawares in many things. Digital is one of them, actually. World Bank has been following others. They've been able to come up with a lot of research and papers now, but they jumped onto that bandwagon quite late in the day. Similarly, climate. So now, they're big on climate, and that's the other big topic that's being discussed right now. And this is where it was found that the funding with these multilaterals and bilaterals is not enough, and they need to get or mobilize more funding. And private sector, of course, is it's the engine of growth. They are the ones who have probably better skills in terms of managing projects, in terms of structuring projects. So they need to be pulled into this. And there are 2 or 3 ways that they've been pulled into it. One is obviously the sustainability factor, the ESG. And that's come about because of regulatory frameworks, because of various stakeholders, advocacy groups like the one I'm on in Frisco. They put pressure on companies that they need to, and that better than anyone else, that they need to adhere to these norms. So that's one reason. But then again, they're not putting money into projects unless they are sure that project is going to work. And that's where blended finance comes in. The multilaterals have now got to think that they're bringing in private sector money, but there's more responsibility on them to make sure that project works. Because otherwise, 2-3 projects which haven't worked, and the private sector is not going to come again with these multilaterals.
True. Yeah.
So that's a big responsibility on them. So that's work in progress, by the way. You have a lot of funds now, impact investment funds, because of the stakeholders and all that, but it's just minuscule. It's like $1 trillion right now. And estimates say you need more than 10 trillion just for addressing the climate part of this sustainability thing.
Yeah. I think there are 2 sides to it as well. One is we often hear that money is not deployed fast enough, and then the private sector often says there are not enough bankable projects there. So how do we get them together so that we can actually make this work?
Right. So that again is the role of a DFI. So the additionality part, so IFC, by the way, the institution I work for, have come up with a framework for everyone, but then they actually put it in place that when you're looking at a project to invest in as a DFI and you're using blended finance and bringing it, so you need to look at the development impact. Is there a development impact? If there isn't, then any private sector bank can do it. Why is the DFI involved in it? So that's the first rationale. There should be a development. The second is there additionality, that if the World Bank or IFC didn't do that project, would any other bank come and do it. If they did, then we don't need to go in, because then we are displacing private capital from coming in, which, by the way, has happened a lot of times. You know, IFC, World Bank has competed with private sector, which they should not be, because that's not where their capital is supposed to do. But that's changing. I mean, part of the evolution. So additionality, they have a role, and that role is that if we had not come in, we could not mobilize more funding. So that's a big role. Then the third, more important one, which is actually what the blended finance is about, the rationale for concessional finance, concessionality rationale it's called. Is there a reason we should provide concessional finance? Maybe there's no need. Maybe, you know, private sector or the regulatory frameworks are there. So once those three are there and there is a reason for providing concessional finance, the concessional finance is used for two reasons. One is for the advisory part. So if there is no regulatory framework, so the World Bank and IBRD and, you know, Asian Development Bank, they all work with regulators, with governments, to make sure that they have a conducive environment for setting up a renewable energy project, for promoting SMEs, for financial inclusion. They work with them. And I've done a lot of work with governments and with regulators to come up with frameworks on how to do that. So that's an essential part. Because if you don't have that, private capital is going to be shy. And you come in, they come on your back, and, you know, the likes of World Bank and IFC, they have the convening power, they have the ability to talk to governments, because they're the World Bank, right? Or even Asian Development Bank, but I talk about the World Bank, you know, more. And so you're absolutely right. So you need all these things in place. Now the thing is, they will not be in place at the time you go in and walk in and you say, this is a project we want to go. So this also has to be simultaneous. And you pull in the private sector already. They're part of that project. And you are working with, you know, raising the skill set, for example, or improving the regulatory framework. So all this has to go in tandem. And there's different modes of financing. So for advisory, you can't use commercial money for advisory. Sometimes it's free money, it's grants that you need to use. And that's in the blend, in the mix.
But what about pricing of capital? We often hear that, you know, developing countries have to pay a much higher interest fee because obviously the risks involved. How can, for example, someone like the World Bank help to have fairer pricing of capital so that there are more opportunities as well in different countries?
Right. Look, I mean, World Bank Group is also a big proponent of commercial market rates. You know, that's because they don't want to distort a country's interest rates. And private sector funding normally is at commercial rates. And that's when we mobilize commercial banks to be part of the consortium, they would want commercial rates. So instruments are there to de-risk that. So the comfort, for example, for a private investor would be, okay, let's share in the first loss, the first 50%. So you have a first loss sharing facility.
Okay.
Now that loss sharing facility is set up with the blended finance.
Okay.
And you are therefore able to bear that loss. But the project itself will give a return which is more, you know, in tune with what the private sector wants. And similarly, there are other products like credit guarantees, for example. For SMEs mostly. So, you know, you would lend and then you are guaranteed that you will get back or 50% of your credit is guaranteed by this credit guarantee. And the funding of the guarantee facility is through a mix of instruments of blended finance. And so on and so forth. I mean, there's several other instruments. There's also another institution of the World Bank Group. By the way, the World Bank is a group, right? There are different institutions. So IFC is the private sector one, IBRD is the public sector. Then they have something called MIGA, which is the Multilateral Insurance Guarantee Agency. So they provide insurance guarantees against political risk. So if a private sector wants to go into a country where there's a risk of, the government might change or there might be a coup in the next, so you can get a guarantee from MIGA on that. So this is also risk mitigation in the private sector. And there are various instances or projects where private sector have gone in with all these guarantees into real, you know, countries which have, you know, not fully developed regulatory frameworks. And, you know, that is, I think, in the nature of private sector also. I mean, they also sense an opportunity in countries which are in turmoil, right? There is opportunity. But the risk is high. And so they also want to make sure that they have everything in place. So that's using your money smartly. And it's not been used smartly so far, frankly, by multilaterals. And multilaterals have had access to this for a long time. It's not something new. they've had access to, concessional funding, to grants and all that. They've pooled it together, but it's never been used. Now, the type of thought that is being given into blended finance is recent. I mean, it was not being done maybe 10 years or 15 years ago.
Because it sounds like there are so many tools already available, but they're not really used in the most efficient manner, probably, or also scaled to a level where more countries or projects can benefit from it. So what would be your recommendation on how this could be accelerated and we could get more capital deployed? Because, in the end, we all talk about just transition. We want the developing world to be able to transition, to develop, to have the means to actually do that within their countries. And currently there seems to be a lot of gaps in that space.
Yeah. Look, I mean, instruments are there, absolutely right. A lot of this has to do with the skill set, I would say, of individuals, because you've got to have a certain mindset if you're working as a development banker or in a development space, and your KPIs have to be aligned with them, which is not always the case. Unfortunately, even the likes of the IMF or the World Bank, I mean, some of their targets is that they've got to dish out, for lack of a better word, this amount of funding in a year. And that's what they'll do. But, what should happen is they should be studying the impact more closely. They should make sure that they're using the right instrument for a particular issue or problem or project in the country. And I repeat it, it's not happening. I think it's also due to the fact that the skill set needed to understand issues facing underdeveloped countries is not there. And on top of that, the KPIs are not aligned. So this sort of doesn't create the right motivation, I would say, for the staff. And I think when you look at the evolution, they're calling it, I would say, restructuring of the World Bank Group, this is a major issue.
Yeah.
They've taken a lot of new people, they've taken a lot of fresh blood from the market. But from what I see, I worked in that as a teacher for 26 plus years. What I see now from the outside is it's not the skills that are needed for that type of institution. Okay, it's not rocket science. You can develop those once you're in there, but it takes time.
Yeah.
So you got this learning curve. So you talked about imminent and, you need to be timely. So it's because of these facts that you're learning as you're doing your job. And on top of all that, it's a bureaucratic institution, because the reason is simple, because you have people from all 180, 90 countries working there, and most of them come from their governments. So it's 190 times more bureaucratic than any other government. So that's the reason for it also. And so hopefully it's understood that, these issues need to be tackled. It's not going to be easy tackling the bureaucracy. And again, cutting across that is politics also.
Of course.
Because major shareholders sometimes want to pull the strings.
Yeah.
They're giving a replenishment, I believe, of $50 billion, which should help the World Bank. I think in these meetings, they're discussing that as well. $50 billion more to leverage and lend out. But again, if they use that $50 billion smartly, again, I think I just remember the figure when they started using blended finance, the figure was that they would raise, I may be wrong in the number, but for each dollar of blended finance, they would raise about $15 from the private sector. And I think the rate now is about $3 or $4 is the only what they've been able to do.
Okay, that's a big difference.
It's a big difference. So if that $15 can come in, then obviously what you are looking for, a quick involvement and helping these countries. And that needs to be done because, the world is not waiting. Climate is not waiting.
Don't get me wrong. I don't just want quick. It should be done the right way.
Right way also, yeah.
And I think we need proper governance around this as well. Like, I think all of these structures, especially when you have multiple parties involved, we need to ensure that there's proper governance structures and transparency. I'm sure you would agree. And especially when we talk about climate change and there's this accusation of greenwashing that happens a lot as well. I think transparency becomes even more important. How how do you see this working together also with the loss and damage fund that was talked about at last COPs, and I think this COP will be probably more formulated? Do you see an opportunity for that also to be part of the conversation?
Absolutely, it should be part of the conversation, definitely, because it's real, right? You know, because of what's happening in many countries, mostly developed countries, underdeveloped countries are suffering and they don't have the resources. You know, forget the resources they needed for their power generation and their SME development and all that. Now, on top of that, they have climate disasters coming in. So yes, there should be a separate fund for that. And as we know, in the last COP, there was no sort of conclusion on how that would be structured. But there has to be a lot of thought given to that. Blended finance could be part of that, but what type of projects are you looking at? Because there's mitigation and then there's, adaptation. So these are two different type of projects. You need different type of funding instruments. But quickly on governance, actually, because that's a very important point. And these type of structures have to be governed properly. There has to be a lot of transparency. And this, what I talked about, the rationales, the three rationales. So this is an attempt by IFC to come up with a structure. Because a lot of bilaterals and governments which provide the concessional financing, and they're providing it, let's say, to IFC for them to use in their blended finance. A lot of other institutions are also using. Again, since I worked for IFC, I give that example. So they say, okay, we gave you concessional money, where did you use it? So there are ways now, they are reporting requirements to the donors. By IFC itself. And they can question, but that project didn't really need to be provided this. So we need to be very sure, that's why I keep saying that we need to be very sure that there's a good rationale for concessionality or not. And this hasn't happened yet. I mean, this is, again, work in progress. So again, to your point, we're still working towards that. Loss and damage, I would say, since the next COP is in this country where we said, so there's a development bank in the UAE as well. I'm not sure that they have started playing a role in specifically in the loss and damage and how they can be more than just UAE and regional or global. But I think they can do that. They should be able to do that. This region is now one of the fastest growing in the world, right? The world is now growing at 0.5% or 0.1%, 0.2%. This region, especially the Saudi Arabia and the UAE, are going to be 5-6% even this year. So they have a bigger role to play also in at least convening the parties and agreeing to who is going to be part of the loss and damage fund. Because we need to do it. We need to do it sooner than later.
Yeah, I mean, we hear a lot of talking is happening. We would like to see a bit more action happening because I think these are all pressing issues. And if we see the natural catastrophes that are happening and affecting so many countries, and many countries that actually haven't caused climate change, let's say, or haven't had a large contribution to it. But I would agree with you. I think governance is super important, and reporting and disclosure on how these projects are managed, what the actual impact is, how do you measure that impact, right? I think that's so important to avoid these, accusations or claims that it's not appropriate or it's not right or it was not having the result that was anticipated. So when I think about the World Bank, obviously there's really a great opportunity now to take a leading role and, like you said, to have that thought leadership to move the needle. Would you say that this is something that we can see happening now?
I hope so. I hope so. I mean, look, with everyone now converging and, actually realizing, it took a time for people to even realize that it needs to be restructured. A lot of people thought they're doing a very good job. So now it's on the agenda. It's a top item on the agenda. So why not? I mean, look, you can make changes if there's a will, there's a need. Institutions change, right? I mean, we change all the time. The thing is to change smartly. And then, in today's world, the changes are rapid. So you may change and you may need to change again, especially with technology. So it's not that you've changed and now you're going to be there for the next 20 years as you are. it's probably next year you might have to change again. So this nimbleness has to come into these institutions, which is lacking. I mean, they're not nimble. And private sector people will tell you that. You know, anyone who's dealt with IFC or the World Bank, you know, they have to wait and wait and wait till they get involved. So this needs to be looked into and addressed. And hopefully it's not impossible.
So maybe we could look at technology as an enabler to actually speed it up, to give more transparency in the process. Do you see that there's an opportunity for that?
Absolutely. I mean, technology has provided us a tool, all of us, to do a much more and to speed up whatever we were trying to do, to speed it up. And, you know, we've got data, you know, just talk about evaluation. And, you know, World Bank is doing less and less of it, actually. They should be doing more and more of it now. And with technology, it's much easier. You know, you collect data, you can, you know, slice and dice the data using technology, not the way we did it before. So they can do many more evaluation. They should be doing many more evaluation. I think that's one of the calls that are going to be made in this, when you reach in this evolution, that there should be more impact analysis and more evaluations conducted of projects done and the results published. So, you know, there's a traction and private sector can see that. So this is also, I think, on the agenda.
Because I could imagine in order to pull in that private sector capital, they would want a certain level of transparency. They would probably, you know, want a certain level of reporting and KPIs to be set and the impact to be measured because, you know, they want some return on their investment, right?
And return, and also they're looking at the social return as well now. You know, companies want to tell their story. But because of our investment side by side with IFC, we've enabled job creation, we've empowered women, we've found solutions for healthcare in, you know, in Gambia, in Pakistan, in India. So they also have to tell the story, right?
Yeah.
Because that's what they've signed on to over the last few years. So they need to make sure that it's happening. Yes, we're all in it together now, private, public, multilateral, bilateral.
Yes.
And coordination, by the way, again, there's so many things in small. That's also been lacking. The reason, you know, this was not smartly done is, you know, there are several DFIs I've named, Asian Development Example. Oftentimes than not, they're chasing the same projects in countries because that's the one which will give them their KPIs.
Yes.
And that shouldn't happen, right? There are 4 other projects, and the reason you're not, you know, targeting those is because little more risky. And we need to, so coordination among the DFIs, the multilaterals, and which is not easy, but that's very important. Again, UAE might be able to, you know, given their diplomatic wins in the last decade, I would say, you know, the UAE has positioned itself as a voice in the world. People listen to the UAE. I mean, this is something they can take on themselves. Get everyone together, agree on what your priority is in this country, this country, this country. And that's what they should do. You shouldn't be doing the same thing in every country.
Yeah.
It's still happening. You're doing the same thing, using taxpayers' money, using grants for the same project. But one coming from Asian Development Bank, the other from the World Bank, third from Islamic Development Bank, all converging onto the same project. You know, they're supposed to tread in territories where no private sector will go. That's basically what it is.
Yes.
They go. And then once they're done with it, the private sector said, wow, now this country has become, you know, palatable for us.
Yes.
We can come in and invest. That's actually what the role of DFIs is.
Yes.
Go in, make a country market. And then, so it's actually working yourself out of a job. And I used to say that again when I used to work in. And if we haven't worked ourselves out of a job so far, we've not been successful. If there's still places where we are needed, we're not successful. In 75 years, private sector should have taken over. Again, this is my personal view.
Okay, so but still, I would say in summary, there's a huge opportunity for blended finance to move this forward. I mean, if we can attract $15 to 1, that would make a huge difference, I believe. And then also giving that finance to countries that maybe have been overlooked in the past because of risk appetite. I think that would really be a great opportunity. So overall, would you say you're optimistic?
I'm always optimistic, actually.
Good.
I'm always optimistic.
All right. Okay. All right. Thank you very much.
Thanks.
Thank
It's
you
a
for
pleasure.
the talk. It was very insightful. Thank you.
Thanks.